Afternoon, everyone. On behalf of the Asia Pacific Center for Environmental Law at the National University of Singapore, I am delighted to welcome our distinguished panel of speakers and our audience who are tuning in from all over the world for this webinar on environmental governance in the financial sector. For those of you who may not know, APCEL is a NUS-based research center of excellence that focuses on the research and development of environmental law in the Asia Pacific region. Our research areas cover a wide range of environmental issues, such as climate change, international climate change law, biodiversity, the protection of the marine environment, and illegal wildlife trade. Today's webinar is the second of APCEL's webinar series on corporations and the future of environmental sustainability, where we explore the complex but necessary role of corporations in environmental governance and sustainability. This series is part of APCEL's 25th anniversary celebration, and the last session will be held on 6th May, which deals with environmental governance and shipping. So I hope you'll be able to join us then as well. Without further ado, I will hand over the stage to Ghislaine, our researcher, who also has extensive experience in sustainability. Thank you, Ghislaine.
Thank you, Tara, for these welcoming words and for the kickoff webinar series on corporations and the future of environmental sustainability. And I'm again honored to have the opportunity to moderate this session for you today. So today's session is on environmental governance in the financial sector. No one can have failed to notice that the topic of sustainable finance is trending. Almost daily we read about ESG investing, green loans, ESG disclosure and regulations, FIs and net zero pledges, green taxonomies, greenwashing, stake and shareholder expectations to promote sustainable finance. And climate risks, along with other ESG issues, are rapidly increasing in relevance for analysis and decision-making in the financial sector. And this is not strange, as it is clear that the financial sector plays a key role in advancing the sustainable finance agenda and in mobilizing the necessary capital to deliver on both the Paris Agreement and Sustainable Development Goals commitments, and also to deliver to national commitments such as Singapore's Green Plan. Sustainable finance, capital flows, risk management activities, and financial processes can promote sustainable economic growth and can help build low carbon economies. And the financial sector can ensure that investments support a resilient economy and a sustainable recovery from the impacts of COVID. Furthermore, it is clear that climate change is a systemic risk for lending and investing and should therefore be managed in a proper way. So sustainability standards can push the sustainable finance agenda, and it is noticed that the landscape with regard to sustainability standards in the financial sector as well is rapidly evolving. Voluntary sustainability standards have been developed to address the environmental, social and governance risk, such as the MAS guidelines on environmental risk management. And various standards are likely to move towards mandatory standards, such as we already see on non-financial disclosure in the EU. And in this webinar, we will hear the perspectives of academia, a bank and an investor. What are the developments on environmental governance in the financial sector and how are various standards implemented? What is the driver for sustainable finance and what are the challenges? And I'm very happy to have this discussion with you with a great panel with top experts from academia and the financial sector. But before we start, some housekeeping rules. We will take questions after the presentations. So please put your questions in the Q&A box, and the presentations are recorded, but the Q&A will not be recorded. And with that, I would like to introduce you to the first speaker, Mr. Joseph Chun, well-known at NUS. Mr. Joseph Chun is a partner in the environmental, social and governance practice at Chun & Bock, a leading law firm in Singapore. He is concurrently an adjunct associate professor and a member of APCEL at NUS, where he teaches environmental law. He has spoken and written widely on various aspects of environmental law and ESG. So I'm delighted that he's joining us, and I'm looking forward to hearing your views, Joseph. So the floor is yours.
Thanks. Yeah, so thanks Ghislaine for the introduction, and good afternoon, everyone. I'm very pleased to be here today to share with you some of my views and my readings and my thoughts on the subject of environmental governance in the financial sector, focusing in particular on the role of law and sort of where the law fits in my view. So first, the business case. Why has sustainable finance been suddenly so talked about? And taking the point of view of the firm, the business, there are opportunities and risks with the growing sort of awareness of what climate change is and what it does and what it could do. And of course, there's also the other environmental risk apart from climate change, although climate change is the most sort of prominent one currently. The opportunities for the firm are to be the first mover, take the lead, recognizing values of the investors, the employees, and your customers, the preference and the concerns, particularly those who are in the millennial sort of generation. Then, of course, there's the potential for financial returns, investing in green and social sort of purposes. In some cases, okay, not all, can bring extra returns beyond the normal sort of investment sort of risk return sort of risk return standards. But apart from the opportunities, which actually what most firms tend to focus on. Okay, this is my experience talking to businesses. They're very keen to explore the opportunities, but risks are less sort of talked about, but nevertheless very real and important. The risk are that the legal risks, the potential for criminal and civil liability, climate change litigation is now taking very active around the world, particularly in the US and in Australia, but also in Southeast Asia and Asia. Reputational risk has become important because of social media. It's easy to share information. It's also easy to find out, to get information through your own research. Also, data is becoming more available. Technology has helped that in the form of, say, satellite data. We saw how satellite data helped us to know when forests in Singapore were being erroneously cleared. Without that satellite information, we may not have been so clear about the timelines. Physical risks, that's quite obvious. Climate change is already bringing in a lot of extreme weather, and we can expect more extreme weather and also chronic weather changes like rising sea levels. Transition risk is something that is new. It's in terms of a concept that, as Paris Agreement already points out, the world needs to the world has agreed to pursue efforts to keep global warming to below well below 2 degrees, and striving to achieve not more than 1.5 degrees rise in terms of pre-industrial temperature. So transition risk tells us that if the world is going to hit this agreed target, then the science says we have to be at net zero collectively by 2050, net zero emissions. This means that we're all going to be in a very different kind of world than we are today. We will be very low carbon. We will have carbon sequestration. We will have different kinds of transport. We will do different things differently. And what does this mean for the businesses today? There will be risks because there will be changes. There will be consumer preferences, changes to preferences. There will be changes to law, changes to policy. Technology is going to be very different. So all these things means that there is a risk that whatever it is you're doing, whatever it is you're investing in today, and whatever it is, well, your assets today may risk becoming obsolete very quickly or beyond their usual economic life. Counterparty risks would just mean that if the people you do business with get into trouble because of all these other things, then you could be in trouble too. So just sort of quickly talk about the opportunities. As Ghislaine mentioned, there have been a lot of voluntary standards. These sort of set standards for finance institutions to know when a loan or a bond is green. I won't go through the standards because there are a lot of them. To just take two, for example, there will be the Green Bond Principles by ICMA, the International Capital Markets Association, and there's also the Climate Bond Standard. Climate Bond Standards is by the Climate Bond Initiative. Okay, the idea behind these standards is that there are two kinds. There are purpose-based standards, whereby you take a loan or issue a bond for a green purpose, and there is monitoring and there's tracing to make sure that the funds go to where they're supposed to go to. There is also reporting to make sure that the funds do indeed go where they're to where they are going to, and there's external verification. Usually there is external verification by a second party who's a consultant who says, yes, this is green, the purposes, the impacts are real, or the projected impacts are real, so this is a good green loan or a bond. There are incentives being given to promote this green finance activities, which is used to fund the green purposes, as I mentioned. MAS, for example, has a green bond grant scheme to give incentives for borrowers to take green bonds, to issue green bonds, and the incentives go towards defraying the expenses of getting a consultant to basically certify your framework. There's a similar sort of scheme called the Green and Sustainable Loan Scheme, and that's more for the loans as opposed to the grants. Okay. Now, are green finance or are green financing activities doing what they're supposed to be doing? They are still very small. Helen Avery, a journalist, has pointed out that it's still a very niche sector. This is a 2019 article. And there's a lot of opacity because the standards are voluntary. Everybody's has their own standards, following different standards, and the definition of terms are not consistent. So there is still a very niche market, and it's not very clear in some cases that it's actually doing what it's supposed to be doing. And importantly, for these standards, additionality is not a requirement. You could already be deciding to give a loan, and then on hindsight, as an afterthought, decide to label it green because it meets the requirements. So in terms of did this green loan actually make a difference? Well, it was going to be lent out anyway, so may not make that much of an impact. Okay, so this is also figures showing you that banks are actually increasing their green loans, but at the same time, they are also not reducing their loans to dirty or pollutive activities. Okay, so on the one hand, supporting the renewables, on the other hand, supporting the fossil fuels. So this is just also to tell you that, yeah, the banks that are leading in green financing are also leading in non-green financing, or financing the non-green. And so there's a bit of unhappiness over this confusion, what's green and what isn't. So what on the risk side, there have been also many voluntary standards to try and get financial institutions to be more responsible. And speaking generally, these focus on senior management commitment to be more responsible, integration of ESG considerations into activities such as ensuring asset investment and lending, pledge to commit to work with others to achieve these purposes, commitment to engage with stakeholders, and then commitment to be accountable through reporting. The challenges are, of course, as I mentioned earlier, similarly for the risks, it's the lack of harmonized guidelines. Methodologies are still evolving. Data is still not complete and not always reliable. There's a lack of transparency. People choose to disclose what they, I think, want to disclose. The focus is still, sadly, because of the way business works, very focused on short-term goals. And there are some directors and management who still think that their primary duty, legal duty, is to maximize profit. It's no longer the case, but it's a conception. So because of that, because of the lack of information and clarity, price signals are mixed, and they don't take into account the long-term risks as well as the externalities which are not fully internalized. Okay, and as a result, we're not totally clear what the financial risks and opportunities for sustainable investment are. There's also a problem of legitimacy with all these voluntary standards. The question is, should investors be the ones who decide what green means? And should banks collectively set standards to decide what green means? Or should this be something that is democratically decided through political office holders who are accountable to the public? Okay. What's the law doing? The law has begun, well, regulators have begun to recognize that climate change as well as other environmental risks are looming in the horizon, and they have started to take action. Mark Carney spoke about this risk. Mark Carney was the Bank of England governor. He spoke to this at a Lloyd's dinner, and he's also head of the Financial Stability Board, which is a body of central banks who are a collective looking at financial stability. And so what happened was the TCFD was set up by the Financial Stability Board in 2015. They came up with disclosure standards in 2017. Another development was the setting up of the Network for the Greening of the Financial System, the NGFS. This was set up in 2017, and they've come out. It's set up as a voluntary association of central banks who are concerned about climate change risks and other environmental risks. And so they've let out a number of publications to recommend to central banks how they should address questions on environmental risks. Okay, and also to the financial institutions. And so regulators around the world have started to take action through expectations and guidelines on managing climate change as well as environmental risk. This is the UK one. This is the European Central Bank. And in Singapore, MAS is also MAS is one of the founders of the NGFS, and so not surprisingly has also sort of spoken about the environmental risks. So MAS is doing a few things. It's trying to promote the green finance market, that's developing of markets through improving disclosures, etc., giving incentives, setting standards, but also trying to address the risk side, building resilience. Ghislaine mentioned the environmental risk management guidelines. The industry has also published implementation sort of guidelines to help banks to meet the expectations of MAS. Okay, there are more disclosures coming up as a result of these risk management guidelines. In terms of impact, I would say that the study done in 2018 is that there is some, it's a bit early to say, but there's some suggestion that the codes and regulations do make an impact in terms of reducing the climate change risk to financial institutions. But when it comes to addressing the impact of the financial institutions on society, the impacts, the climate change risk and environmental risk caused by financial sector, the suggestion is that the impact is actually currently still very low. Okay, although there is some noticeable impact on the risk on the financial institutions, but not so much of the risk or the impact on financial institutions on society. So what's going to happen next? Currently in Europe, there is already some movement to to make it mandatory for financial institutions and businesses in general to identify and assess the impacts, the environmental and human rights impacts of their activities outside of in their country as well as outside their country. So this is mandatory. They're going to have to disclose it on pain of regulatory and criminal and potentially civil liability. So I'm going to end with some concluding remarks that it is very good to see the voluntary market, sort of the market taking voluntary steps to land green and also to take account of environmental risks. But This is very good because when businesses do things voluntarily, it keeps the implementation cost and enforcement costs low. However, this is not enough. The market as a tool, as a policy sort of approach to solving problems has its limits, because they end up not fully internalizing the externalities. So there is still going to be need for regulators to supplement this market enhancing mechanisms with mandatory laws. For example, they could mandate that FIs start to set net zero targets, whether it's based on 2050 or based on a respective country's NDC, something that we can discuss, but there needs to be some mandatory action and not just disclosure. Okay, so I'm going to leave with the wise words of Greta Thunberg. Treat the crisis like a crisis. I think we are still not treating the crisis like a crisis. We are still thinking we have time to get more information, do more research, and so on, but we don't. Okay, that's it. Thank you.
Thank you very much, Joseph. This was great how you set the scene for this webinar. And also to give an overview of various standards, and that there is a need for harmonization of those standards. And I think the central banks are taking action as well, have an important role to play. And this can be helpful, not only focusing on disclosure indeed. And in that way, I think your observation that from one hand, we see financing renewables, but there is still financing of fossil fuels as well. We always say responsible finance, applying risk management criteria to your lending activities goes hand in hand with sustainable finance, financing the opportunities. So it is important as well to focus on managing those negative impacts, those externalities. Thank you, and I'm looking forward to deep dive in your tap on your knowledge with the Q&A. And then with that, I would like to switch to our second speaker, which will be very interesting because it will be the voice of the bank. So how is a bank implementing a sustainability strategy and environmental governance? And I'm very happy that we have Mehrunisa Zafar. She's a Vice President responsible for finance at DBS. Mehrunisa joined DBS in 2018 as part of the responsible finance sustainability team of the institutional banking group in Singapore, DBS. And her work focuses on the ongoing evolution and implementation of the bank's responsible financing framework, working on environmental and social issues relating to the bank's lending activities and transactions. And I believe Mehrunisa has been also quite closely involved in with the MAS on the environmental risk management guidelines and the handbook. So I hope to hear some more details on that as well. And she graduated with a Master of Science in Environment and Development from London School of Economics and Political Science. Mehrunisa, we are very happy that you're joining us, and I would like to give you the floor.
Thank you very much. Hello, everyone. I'm thrilled to be here. Thank you for having me as a part of this panel with my other fellow panelists. Thank you for the introduction. I'm part of the responsible financing team at the institutional banking group at DBS Bank, and today we'll focus on sustainable financing, looking at the state of play, where we are at, and where we need to go, what direction we need to go in, and what DBS is doing, of course. Can we move to the next slide, please? Thank you. I think it's important to say that, I truly believe, and this is my personal opinion, that sustainable finance will become mainstream finance. It must become mainstream finance over time. As per the Paris Agreement, of course, governments have a shared goal of keeping the global temperature rise this century well below 2 degrees, ideally, within 1.5. And a significant amount of investment is required to transform our economies into sustainable ones. To facilitate investment, we need a well-functioning financial market with availability of green funding instruments, and the gap, just to give it some context, in investment required across the SDGs is around $3 trillion per year just for developing countries, and that it doesn't even look at the finance gap for climate-related investments required, which is $5 to $7 trillion per year. And when we look at the amount of investment required, we, of course, it goes without saying that green and sustainable financial instruments do need to contribute to closing this gap. And across the board, we see the banks financial institutions have picked up pace. At DBS, we've closed about 9.6 billion in sustainable financing transactions across our lending portfolios last year, and raised over close to about 9.7 to 10 billion in sustainability-related bonds. And we're so pleased with our progress that we've actually doubled our sustainable finance targets from 20 billion to about 50 billion. However, of course, again, it goes without saying that the speed and scale of climate investment is still far lower than necessary, than what is required. And, the hindrance factors that hinder the growth of the sustainable finance market have been, touched upon. Governance-related factors, development of taxonomies, hesitance really to venture into the world of sustainable finance for fear of greenwashing. For example, many corporations think that sustainable finance, it does not apply to them, and I think that's because sometimes because user proceeds finance, whereby the proceeds have to be used for green assets, has focused on sectors and activities that are for which climate action has been relatively straightforward. So that really shows us that there are some issues that we need to kind of overcome. Climate change opportunity and risk management, of course, needs to become business as usual as well in the financial industry, and embedded in everyday business decisions, products and services. And that will take time. It's not going to happen overnight. We do see actually our clients, our borrowers, customers coming in and asking for the ESG being embedded in the green aspects or sustainability aspects being embedded in almost all kinds of services that we are offering as a bank. Of course, that brings me to the very interesting discussion on taxonomies that are available at the moment, that are being developed. The search for consistency remains a priority, of course, and the key to achieving this and to enabling the development of reliable market data, we will need to have standardized definitions of what is sustainable. Now, I do have to say that I don't think it's completely lacking in the market. There is the International Capital Market Association and the Loan Market Association, the LMA. There are guidelines that banks can use and rely upon to make these green financial products quite robust. Of course, banks do things differently based on interpretations of, what is green. There are different shades of green to add to the confusion. Some businesses and some industry sectors are very much pure play dark green, and some are, it's not that clear. So, of course, there is that judgment that has to be made, and it is a bit subjective sometimes. Although I think the harmonization is happening at quite a rapid pace. So recognizing the challenges that companies are facing in making ESG disclosures is also based on, the taxonomies that are developing, and the sentiment in the market is changing so quickly as to what is considered green and what's really environmentally sustainable. Is it going to be around in 30 years? There's so many criteria that companies need to look at, financial institutions need to look at. So standard setting bodies also looking to enhance and align their approaches to corporate reporting, both financial and non-financial here. So, how do we overcome this? It's easy to say, but of course challenging to implement, given the tangle of co-benefits and trade-offs, and the difficulty in establishing measurable metrics using these harmonized taxonomies. So one thing I'd like to touch upon here is the focus on defining transitional activities and assets. that are associated with the highest, carbon emitting industries and businesses. And why I'd like to touch upon this is because the largest sector of industry that really is ignored when we talk about sustainable financing is the industry and the business segments that really need to transition the most. They are considered, mostly brown, so not green, and form the largest part of the industries that need to undergo that transition. So, as I mentioned before, capital flows have principally been directed at activities which are considered already green, and there has been significantly less investment into transitioning activities and assets, and the largest greenhouse gas emitters are still largely absent from when we talk about sustainable finance. And this presents banks and financial institutions a huge opportunity. Whilst these actors may not have played a significant role in the green finance market to date, they have a vital role to play if we want to reduce global emissions. And they're often key constituents in mainstream investment portfolios. So to encourage carbon-intensive companies to adopt more carbon-efficient technologies and operations by considering commercially viable greener alternatives, DBS Bank came out with the Institutional Banking Group Sustainable and Transition Finance Framework and Taxonomy. And it's the first in the world by a bank. And whilst we do not claim that this is the unifying definition of transition, it's how we understand transition using science-based targets, using sustainable development goals, looking at how companies are aligning with the Paris Agreement. But also, I think the ultimate aim is to support the transitioning of the largest section of the biggest greenhouse gas emitters as part of a larger and liquid climate-related market, and to deliver confidence to investors and credibility for issuers. So, of course, we use the term quite judiciously because it can be quite easily construed as, okay, are we looking to finance the brown industry and just, calling it sustainable and making that transition? But actually, the criteria we use is quite robust. For example, we look at, what is the science behind those technologies? Of course, we try to make it as robust. What trajectory is it aligned with? And also, technology, of course, trumps economic competitiveness when it comes to really transitioning, and look at action by corporations and not just pledges. So it's on our website, and it's we hope to do a lot of transition financing that is really meaningful in helping companies move the needle here. Next slide, please. So what's required for meaningful, effective change is I think what we've seen in the market already, and this is not to say that all of these things are not happening. Absolutely, there is great momentum when it comes to risk management. I think most financial institutions are really looking closely as more and more central banks and regulators are coming out with their own guidelines and taxonomies on what is expected, and that climate risk is a real financial risk. So integrating climate-related risks into financial stability monitoring and supervision. We see a lot of financial institutions doing that already in Singapore, designing their, identifying environmental risk, and also looking at, how to integrate that into their existing enterprise risk management. And the MAS environmental risk guidelines require this of all financial institutions as well. When we look at public policy framework, regulatory bodies, and policymakers, we welcome all of these moves as a move to really create an enabling environment to kind of, of course, there are different levels that financial institutions are at. Some are starting out, some have been on this journey for many years, but really the MAS guidelines cater to all, those who are just starting out, and provide quite a comprehensive framework for them to get started on this risk management journey. The EU has, of course, led the way on financial services legislation, and other jurisdictions are picking up on the momentum. There is a pressing need for Asia Pacific and the governance and markets to show leadership here. And of course, Singapore, as a leading financial center, is doing the right thing to help reduce carbon emissions, promote sustainable development, but really not just in Singapore, but in the region as well. And the MAS has a very comprehensive long-term strategy to make sustainable finance a defining feature of Singapore's role as an international financial center, just like wealth management and fintech have become. So, I won't go into the details of the action plan that MAS has, but regulators have made strong inroads in addressing market failure, or starting to address this, and the environmental externalities, and I think capital flows have, they are flowing in that direction. I think one thing I'd like to touch upon is that financial systems are facing a new landscape of transparency requirements as well. So there's greater transparency around the key material issues, which will increasingly affect access to capital for corporations and asset values in high-risk sectors. So a growing landscape, we can see it happening, especially in 2021, of sustainability standards and disclosure requirements throughout the financial and corporate systems, and which will increase scrutiny and oversight. At the macro level, like I mentioned, central banks are driving efforts amongst banks and insurers to conduct climate risk tests, and which they will review. And of course, the financial sector's response to climate change will also be under greater scrutiny this year, with, Mark Carney's leadership of the UN Climate Change Conference, the COP26. And of course, now that the US Federal Reserve has also been added to the NGFS at the end of 2020, which of course is a sign that US financial regulators will be placing more importance on ESG issues under the Biden administration. So we can see that there is a more robust landscape emerging as well. I think the other points that, I kind of like to touch upon is, consistent climate disclosure. So financial institutions alone cannot come up with, TCFD reports that are very meaningful unless there is information available that's meaningful from the borrower side, from our customers and clients. So there is increased pressure on both sides. And the TCFD, of course, which is the task force on climate-related financial disclosures, have produced recommendations to help companies disclose their climate-related financial information. And building awareness overall and capacity building is going to continue to increase. I think there is already a focus on technical assistance and knowledge sharing across the board and globally. And in Singapore, we can really see it moving as well. So I will stop right there.
Thank you, Mehrunisa. Very interesting to hear, and I think, the challenge that the MAS or as a regulator has is indeed to cater all financial institutions, and also then to create a level playing field. But I think the step that the MAS took with the environmental risk management guidelines is, of course, very important in that way. And now it's all about implementation. And indeed, I think the financial sector has noticed DBS Sustainable Finance Framework, what you were referring to, the first in the world, which is focusing on indeed what is transitioning finance, and it's very important, I believe as well. It's not only about financing the already sustainable assets, etc. And maybe, correct me if I'm wrong, maybe it's also important to mention that the framework was also validated by an external party.
Yes.
Yeah.
We've got a second party opinion from Cicero, and we try to make it as robust as possible. But again, the landscape is changing quite rapidly.
Yes. That's also true, yeah. We will come back, I'm sure, at the Q&A. Thank you so much again. And with that, I would like to introduce our third and last speaker, which is Munip Madni, who will give us the investor perspective. Munip is the founding Panvestor at Panarchy Partners and lead PM of the global Panvest Fund, a portfolio of purpose-driven companies. And Munip founded Panarchy Partners in 2018, pioneering the Panvesting philosophy, a natural and required evolution of investing involving the 4 forms of capital: human, social, environmental, and financial, that a firm needs and nurtures to deliver on their purpose and still make profits. He has received a Bachelor of Business LLB from University of Technology, Sydney, and he also obtained his CFA designation in early 2000s. In June 2020, he graduated from the Master of Science Environmental Management program at NUS. So he's also well known to NUS and APCEL, and I'm very happy to have you here, Munip. The floor is yours.
Thank you, Ghislaine, and thank you, APCEL, for actually having me on this esteemed panel with Meru and also with Joseph as well. So for today, what I'm planning to do, and let me just share the screen. I always just confirming you can see the screen.
Yes, we can see the screen.
Right. So what I intend to do today is talk about investing and governance of environmental management within investing from a, you could say, 20,000 foot level and then a helicopter level. I will not go into the minutiae of it, but I will talk about how investing and the governance around it and where we are at currently with the challenges. Most of what I will leave today everyone with is some of the challenges that we are facing within the investing world from a governance perspective on environmental management as well. Before that, I will also share with everyone that investing itself has evolved while people still look at investors and think that, okay, people like to mention BlackRock and a few others who over the last 2 years have started talking about sustainability in a big way. But I will share a little bit of evolution of investing as well into how and why investing, or what people know as wealth creation or wealth management, why it's taken its time, but it's finally come to the party when it comes to sustainability and environmental management. So that's generally what I'll be covering today. If I can just now share. So first of all, I think most investors are here. They do not want to be feeling guilty about making money anymore like they most probably were taught in the 1980s. Most investors don't want to leave the planet in ruins while they've created shareholder wealth. And I think what we're finding is that people also realize that financial capital and financial markets have truly come of size in the last, let's say, 30, 40 years. When I was still in high school and aiming to become a fund manager in the 1980s, at that time, the value of stocks and bonds was only equal to the global GDP of the world. In other words, all financial investments were equal to the goods and products and services that were being created. Fast forward to 2017, and that level has gone to about 3.5 times global GDP. And over the last 2 years, especially since COVID has brought down the global GDP, but financial markets have gone through the roof, and wealth creation, if you measure it by stock market valuation, has gone further and further up. You can say that the value of stocks and bonds, and in other words, wealth as a percentage of GDP or a multiple of GDP, is tremendous. So for investors now to just wait for consumers, service providers, manufacturers to get their environmental footprint correct is not good enough anymore. And I think that's something that has come to the realization of asset owners, to asset managers like myself, and even companies that are looking for financial capital, whether that be in the form of equity or debt from the asset owners and also the asset managers. And that's very, very important. What I intend to do now is maybe share with everyone a bit of history of the investing world and wealth creation, and how sustainability for mankind or human beings, I should say, has evolved. And it's gotten to a stage where now we actually need to change. And from that perspective, if we were to see how wealth was created in the x-axis, and on the y-axis, you have environmental, human, and social capital sustainability, what you find is that you do have periods over which sustainability for human, social, environmental capital and the wealth creation for a few, if we look at 1100 AD and before, if you look at even from the first pharaoh, female pharaoh and billionaire actually was Hatshepsut in Egypt. She was the first female billionaire. And if you go all the way to, Genghis Khan in the 1116 AD, sorry, my things are not moving right there. You find that investors or wealth creation was moving from the conquerors and the kings to the conquerors and the elites. And sustainability for environment, human and social capital was not being questioned that much. Yes, social sustainability was very low because there were no social rights. As you moved into 1100 to 1600 AD period, you did find we got the Magna Carta Libertatum. We also found the first humanists come about, and there were certain social contracts that started to be built up. So there was some improvement in social sustainability. Environment was not a concern. We didn't have fossil fuels. Biomass was the main form of energy, but wealth was being created. So investors continue to deploy financial capital without any worry about environment. Human capital was also improving as we moved into the 1600 to the 1900 AD period. This is when we officially first got our first investor with the Dutch East India Company and the British East India Company in 1600 AD. Before that, there was no term called investing or investor. But in the 1600 to 1900 AD, we saw also tremendous improvements in social contracts, and human capital also improved with all the medical technologies that came about in the 1600 to 1900 AD. Most investors in this period only cared about returns. At that time, sustainability was not an issue. And if anything, incrementally, wealth creation helped social contracts and also helped human capital improvements as well. You could say the next big move for investors has been in the 1900 till now, roughly, let's say 1970s. And what we have seen in this period, which is known as the Great Acceleration, we've also seen the fastest growth in human population, the fastest growth in wealth creation, the fastest growth in technology improvements, the fastest use and abuse of environmental resources or natural resources. And so this has been a tremendous period for mankind or human beings to evolve, but also improve their sustainability around human, social, and environmental capital until the 1970s. It's in the 1970s where we first started seeing talk about environmental capital not being treated within the economic system in a proper way. It was in the 1972 Stockholm Accord. In then 1992, we saw it again in the Rio conversations that sustainable development became an important conversation point. And if we as investors did not move until then, no one can blame anyone because the numbers and statistics were not there. It's from the 1970s onwards that investors, smart investors and the careful ones, had to start thinking that investing was not only about risk and return. Investors started to think that return, risk, and impact is what is important. And this is a very important evolution in the mindset of investors that I think is very also important from a governance perspective. It's only now the word impact, at least in the last 10 years, has become a constant term, whether it be for asset owners, asset managers, or even corporations within whom we make the investments. So this investing needing to change is very, very important. And we are seeing that, which is a good sign in my view. If we look at environmental governance and impact in investing, the way I look at it, governance influence in investing actually starts with financial capital owners. These are your sovereign wealth funds of the world, whether it be Temasek, GIC, or SAMA. It's the institutional investors. These are your endowments, foundations, family offices. And then it's individuals like you and I, who are actually investing, whether it be in mutual funds or even ETFs for that matter, or Bitcoin, for those of you who also care about the environment. So there is governance coming from the top by the asset or capital owners. We are the ones who are providing money to and guidance to financial capital managers. These are people like myself, institutional investors who actually help the asset owners deploy their capital. And so even financial capital managers like myself, Aberdeen, BlackRock, we are given guidance from our, let's say, partners who are the capital owners, and then we deploy that to the allocate that to the financial capital users, which are your companies. These are your Unilevers, Singtels, 3Ms, and this is a very simplistic, you could say, flow of governance or flow of governance influence that we have seen for the last 400 years since investor, the term was created. And in the last 50 to 60 years, this has been institutionalized, whether it be through the 1940s Investment Act in the US or various other codified laws when it comes to providing and instructing investment managers and capital owners. If some of you might know that it's only recently that in the US, certain states have allowed their trustees of endowments and foundations to take into account non-financial matters or non-financial concerns as well. So it's very important how this governance flows, this governance influence flows for the three players within investment management: capital owners, capital managers, and capital users. But there's a disconnect here. And the disconnect is that sadly, the environmental impact flows the other way, or the perception is it flows the other way. You actually have financial capital users, which are the owners, and on some estimates, some people have done the numbers, the 90 worst companies when it comes to environmental footprint make up for more than 2/3 of the environmental damage that was done between when fossil fuels started and in the 1980s and 1990s. Obviously, that number has changed. But capital users, the companies which have the least influence at the moment at this point in time, or by the way, the influence starts percolating very slowly to them, they have the biggest footprint. This is then followed by capital managers. And up until now, capital managers like myself have always just hid behind the capital owners and said, well, we've not been instructed. No one's telling us to do that. Why should we go, how many capital managers or financial fund managers actually go and say, we are going to change the way we are investing? The investment management firm is based on, we have been doing this for the last 150 years. That's their selling point. How many of them say, actually, we are going to change how we do? And that is a challenge for the investment managers, which needs some support from, I would say, the capital owners, which are your sovereign wealth funds, your endowments and foundations. And the good news is we are finding that the influential up the top asset or capital owners are moving. They are now changing the way they think, and they are changing their instructions to people like myself, the BlackRocks and the Aberdeens of the world. Now, capital owners and managers, us, what is climate change to us? It's the tragedy of the horizons. Joseph mentioned it, even Meru mentioned it, that it is something that we are too focused. Most capital owners, managers are too focused on the short-term problems. In this case, let's say it's the COVID, and we put our backs to what are in the long term. Even though we are well aware that there's a whole move from shareholder capitalism to stakeholder capitalism, we know that climate change and many of its externalities, their impact extend beyond most political, regulatory, and supervisory, or even company profits and business cycles. And therefore, many people think it's not my problem. And that tragedy of the horizons, that needs to be changed. Sadly, in investment management, people, every time I go and present to someone, the first thing they ask me is, what's your last 6 months performance? So when there's a mindset like that, where performance, financial capital performance is so focused on 3 months, 6 months, 12 months, maximum 18 months, climate change becomes least of most investors or capital owners' concerns. But that is changing, slowly but steadily changing. And how is it changing? Capital owners and managers, they are now, let's say, looking at financial returns, and they're comparing it against the progress on human, social, and environmental capital. And the challenge they find is that there's this perception that if you are worrying about human, social, or environmental returns or capital, you're doing it at the expense of financial returns. In other words, when you invest in WWF or donate to WWF, you have negative returns because it's a donation. But when you go and buy in a uranium mine, you can have very high financial returns, but it's got negative externalities that is really bad. So what happens is that everyone assumes we are sitting in this space. The more impact you have, the less financial returns you have. If you're investing in renewables, again, it's lower financial returns compared to where most investments here. Most people are sitting in this area, in this round circle where this is investments, and there's various levels of progress on human, social, environmental capital. How do we get here? This is the challenge that people like myself as asset manager, for my partners that are capital owners, are aiming at. How do we get to a place where we can get good financial returns and progress on human, social, environmental capital? The good news is these questions are being asked. There are not only myself, my team, but many other like-minded fund managers, institutional asset owners who are trying to find out how do we get to this place and how do we get to this place of good financial returns, but also progress on human, social, and environmental capital. Now, to finish off on the last two slides, what I want to do is talk about capital users. Who are these? These are the firms. These are the companies. These are Unilever, SAP, Singtel, you name it, Olam. What is their challenge when it comes to climate change? And this is something that I learned because my master's thesis for my MEM program was exactly on this, was directors' duty and climate change, and why even well-intentioned directors of companies are finding it somewhat challenging to put into place serious thought and consideration on climate change. So I actually think that even well-intentioned directors have a fairly good legal excuse not to do it if they want to do, and that needs to be addressed. So what is it? First of all, there's this idea of concept of a corporation. What is a corporation? And this is the whole idea about, is the corporation for shareholders or is the corporation for a broader group? And if you want to go into the study of this, there's a great Bowl-Dodd debate that started in 1931 and went to 1960 for 30 years. Two law professors from Chicago Law School and also Harvard Law School debated this whole idea. Is the concept of a corporation shareholder primacy, which is a monist approach, or is it shareholder approach, which is stakeholder approach, which is a pluralistic approach, whereby a company is not only meant to be for the benefit of a shareholder, but also for a broader set of stakeholders. My opinion is that currently it is still very much a shareholder primacy legal approach, whether it be common law or even, let's say, legislated. It has to move to a stakeholder approach to what is the concept of a corporation. The second challenge that company directors face is, how do you promote the best interests of a company? And in legalistic terms, and I'm not going to, I'm not a practicing lawyer, so I'm not going to go into detail, but from my readings and my understandings, it is all about the duty of care. And also the tests that are deployed on it, the objective or a subjective standard. And within that, there's a whole spectrum, which starts from the business judgment rule, and it finishes on the fiduciary duty, with the highest level onus of proof with fiduciary duty, and business judgment rule being one of the lower, you could say, hurdles to jump over for a director to get away with not doing anything on climate change at all. We need to move to something which is closer to an enlightened shareholder approach. No longer can we focus on or allow for shareholders to get away by using the business judgment rule and have them maximize shareholder wealth creation as their proof that they have done the best to promote the interest of the company. What we need is, we need some kind of dual objective, subjective standard of care. We can't use a pure objective standard. And we need to also have a stakeholder approach with doctrine of proportionality, which comes from human rights law. And these are things that in my sort of thesis, I went through in a lot more detail as to, if we can come up with this form or this approach to how a company can be promoted, and we put that in common law or in legislation, that's the time when all these directors who are trying to implement climate change you could say, relevant decisions into their companies can only do so with no fear of being sued by shareholders or being held accountable based on a shareholder primacy. To finish off, for me, the way I look at it is that directors' duty in climate change, how do they avoid it? How can they avoid this legal tragedy I call? And that is, they need to reconsider their purpose and priorities. And what I mean by that even a company and a corporation, like nowadays we are finding certain jurisdictions are allowing for benefit corporations to be created, or B Corps. In the US, the states of Delaware actually has an allocation which is not for profit, it's not a for-profit, but it's public benefit corporations. And those public benefit corporations in their constitution have redefined their purpose, which is beyond just shareholder primacy. And I think that's a very important legal classification for a company. We as a funds management company in Singapore are a B Corp certified. We are the first B Corp certified fund management company in Singapore. It's not a legal status in Singapore. We appreciate that. But in our constitution, we have openly stated that we, as a funds management firm, we are not here purely for shareholders of the firm, but for the stakeholders. So we need to reconsider the purpose and priorities of the firm. Firms need to rethink their modus operandi. How do they actually operate? And that's a whole business model rethink. If they really want to implement climate change into their business model, they have to, as Joseph said, if they're internalizing all these externalities around environment and beyond environment and social externalities and employee externalities, they have to rethink their business model. And again, if they do not have the shareholder primacy stuck over their head, they might have a better ability to do so without seeing or getting sued for what they're doing. Last but not least, they have to, by doing the above two, they need to rewrite their future impact. Only then, I think, can firms and directors feel that they've done the right job, not only to the environment, but also to the firm, to the stakeholders and the shareholders. And with that, I think this is one thing that we believe as a funds management and an investor, is that the value of wealth depends on the use to which it is put. And that needs to be somehow, legalized rather than just left for people to, voluntarily apply to. So with that, Ghislaine, I'm going to pass it back to you. I have no idea whether I've gone over the limit. I apologize if I have.
Few minutes, but thank you so much, Munip, for this presentation and for sharing the investor view. Very interesting, by the way. I thought the historical development, the history going from returns to risk and to impact, and indeed the challenge to change. I myself started working within a financial institution on sustainability around 2011. Well, I think for the first 8 years, there was not so much change, but the last 2 years, I think things are changing rapidly. And that gives a lot of energy and hope as well for the time that is coming. So with this, we close the presentations and we will stop the recording. And we will